Oh, I like your shoes.
All right.
Thank you.
Well, I'm so glad to have this great panel here. Guys, I'm going to just roll right into things and ask you a hypothetical. Say I am this super smart entrepreneur, I've got a great product, a promising young team, and I live in maybe Austin. And everyone keeps telling me I have to move to San Francisco. Is that true? Dana?
Not if you're raising money from Greycroft.
Why is that?
I think 82% of our investments have actually been outside of Silicon Valley. So, we're finding opportunities everywhere, and I think that there are great opportunities and great growth pockets in Austin and New York and LA and Seattle and Chicago, sort of all over the country and all over the world.
Yeah, I think it depends. I mean, if you are based in Austin or New York or Boston or LA and you've got a network where you've got a recruiting advantage in that environment, then it might make sense to stay there. If you don't really feel like, if there's some expertise you need that doesn't exist in the market that you're in, I do think that the Bay Area is, kind of quantitatively the best place to found companies.
Isn't it getting too expensive, though? I organized a dinner last week, and your fellow investor, Chamath Palihapitiya, had noted that being based in San Francisco at this point basically cuts your runway in half. He said, if you live in San Mateo, if you live in Oakland, you can get, so much more mileage out of your fundraise. Does that change things?
I think Chamath said, as long as you don't spend all your money on Kind bars, you're okay.
Right. Jeremy, any thoughts?
The thing is, I really do think you can start a company anywhere. The challenge is scaling that company to the next level. So you can find great individual contributors, you can find great developers, you can find great designers, you can find great product people in any country, in any city, in any town in the world. But then once you start to scale, let's say it's working, and you start to hit 100 people on the team. And now you want to have some VP level folks who are actually not in the weeds doing the work, not even one up, but maybe two up from the front line. Finding the people who have the experience, who've done that before, gets more difficult the further you are from the Bay Area. It doesn't have to be, it doesn't matter whether it's San Francisco or Oakland or the Peninsula or even the North Bay. There is a set of experience, especially on the consumer side, even more so, frankly, on the enterprise and infrastructure side, that only exists here. And there are certain cities in the world where you can, and New York, LA, increasingly in Europe, you're starting to see some of that second generation experience. But if you're in Tuscaloosa, you're going to have a tough time finding that locally.
Right.
And more importantly, you're going to have a tough time attracting someone who has that experience to move there. Now, if you're in a city that is a global city where people are willing to move, and I think LA counts, I think New York counts, Austin, I think, is on the edge. It has some livability stuff that makes it very attractive to people, but it doesn't have the same ecosystem for what people do next, and I think that's something people care about. So really that's the key question. If you can't attract people who are willing to move to your city, then you do have to consider moving your headquarters to a place where those people already are.
Right. Yeah, but I think Aileen made a really key point, though, which is if you have a network, sort of where your network is and what you're focused on. And, I would argue that LA, for example, probably has the most talented people in the media business of anywhere in the world. It's really been the, sort of the center and the sort of central ecosystem, and they understand the dynamics of that market better than anywhere. And so I think if you were starting a digital media company in San Francisco, you'd be recruiting executives from LA. And so, I do think it depends on the industry, and it depends on the network that you bring. And like any great entrepreneur, you've got to be a Pied Piper, and you've got to be able to recruit people anywhere, whether you're in, Reykjavik or whether you're in Chicago. And we've seen great companies in both of those places, and I think that that's a huge part of it, is being able to paint a vision and tell a story that attracts people to anywhere.
Yep. What about new sectors and technologies? Maybe I'll segue into asking what you're looking at that you weren't a couple of years ago. Like, I don't know if there's a virtual reality headquarters, place where you have to have a virtual reality company or an AI company.
LA.
But you just funded a
John.
Yeah, John.
Yeah, we just invested. Just announced this morning. We and Disney co-led an investment in Jaunt, the virtual reality company based in Palo Alto, along with CMC, which is Li Gong-led Chinese investment platform. And interestingly, it's the combination of both the technology and innovation you find here and the specific expertise on related to content and distribution and media that you find in Disney. In ourselves, we own CAA, our partners at CAA, and the other investments we've made through that Evolution Media platform that really drives that kind of investment. So it's a combination of the LA, Shanghai media landscape married to the technology innovation here. And most of the most interesting technology innovation is happening here. Mm-hmm. The product design and all of that, where the interesting channels, distribution channels and innovation around business models is happening elsewhere. Right. So it's really the combination of both.
Aileen, I'll ask you, have you funded anything in the last couple of years that you maybe wouldn't have imagined funding a couple of years ago?
I think we're looking at a lot of things that 2 or 3 years ago we weren't looking at. Obviously, like the food category, I think probably no one was looking at that probably 3 or 4 years ago, and now it's a $1 trillion plus market, so it makes sense that there's been a lot of innovation and it's some exciting startups. We, looking at drones, or for us, for example, we're a seed stage firm, and like we've been starting to look at some more healthcare related things because like when it takes a lot of capital, it's probably not a great fit for us as a seed investor. But when things are now becoming increasingly consumerized, both on the enterprise and the consumer space, then I think it can make more sense for a seed stage investment. And so that's been fun, but also challenging for us to learn about all these new things that we hadn't looked at before, like VR.
I've been hearing a lot more about healthcare and core sciences. How long does it take you to get up to speed on a new sector? It just seems so sort of afield from anything, that a lot of VCs have been doing in recent years.
I haven't done anything in that, so I can't speak to it. But I think, you asked this question, which is like, what are the big sectors that we see? And I'm not sure that actually is how it works out. I don't think that we foresee where the opportunities are. I think that the entrepreneurs see them, and then we kind of react to that. It is really hard to predict the future. It's a lot easier to just observe the present and see what's working, and then trying to suspend judgment as to like, oh, that's a stupid idea, or that's never going to work, or that's just for kids, or that's not going to scale. Like that's the bit that gets tricky. But seeing the future, is very, very difficult. I mean, we invested recently in this company called Giphy. And that's been seeing just tremendous growth on the back of this wave of GIF adoption that's been driven by messaging and social media. And I couldn't tell you that we had this thesis that GIFs were going to be a big driver, and that this was the right time because of various. I mean, like none of that made sense. GIFs have been around forever, since at least since the early '90s. And so why now? Why
it's like forever in our world,
which is. But the point is, like, we didn't need to have a thesis as to why it was seeing this inflection point now. All we needed to do was to recognize it, to see who the leaders were, and then to suspend the judgment and say, oh, that's not silly. It's actually a meaningful thing. And that's where I think, having some of the context matching of being able to say, okay, this fits into a lens of, self-expression that has its roots back from, email signature files through, AIM buddy icons and MySpace profile pages, and like you can sort of start to see that kind of connection. That's where, I think having the sense as to where things are going connects to where things have come from is important. It's not necessarily saying, oh, here is where the big opportunity is going to be.
Okay. We have a slightly different model and tend to find that we work with investors like these as partners along with the entrepreneurs that they've backed. But we're really investing within industries where we have a strong history and track record. So healthcare is an example. We're probably the largest healthcare investor in the world, investing across services, biotechnology companies, drug discovery companies, allied pharma, et cetera. And it really gives you a different perspective and allows us to be a strategic partner to companies. So we tend to find ourselves not competing with venture firms or earlier stage investors, but rather coming in when we think we can be a real partner. So when we got involved with Uber and Airbnb, Lynda.com, these kinds of businesses, we came in because the entrepreneur wanted a partner that was global, that had deep industry capabilities and a toolkit operationally that allowed us to help them scale. So we're jumping into the boat with them and helping them row strategically, as opposed to being particularly wise at understanding where things are going to unfold at the earlier stage.
I think it's so interesting. I think a lot of people don't realize that TPG Growth, it was a somewhat early investor in Airbnb and Domo and
Uber.
And Uber. And I think a lot of people sort of think of TPG as being one of these firms that comes in and drives up valuations. So I'm going to sort of back into that, talk about valuations. First of all, what do we do here? I mean, it's obviously a problem. Are you writing bigger checks? Are you writing fewer checks? Aileen, how are you handling what's happening out there?
You know, we're kind of at the beginning of the supply chain of venture capital, right? Because we do seed. And so I'd say, like, for us, this year we've been slower to invest. Partially, I think, like in our analysis, there are years that have like lots of great new ideas where they're kind of big swings that are going for very large industries. And I feel like a lot of the, like, maybe last year or the year before were better years for big new ideas. This year we haven't seen as many, we think, big new ideas. And a lot of the ideas are looking for higher seed stage valuations. And I think the entrepreneurs who are looking for pretty, what we feel like are somewhat rich valuations, they don't realize that they could be setting themselves off on the wrong trajectory for the rest of their life. And so we try and balance the fact that, like, sometimes it doesn't, like, the valuation doesn't matter if you're in on something big, you know, whether it's 5 pre or 10 pre or 15 pre, you want to be involved with those entrepreneurs and part of that company, but you don't want to set the company up for failure because it started out too expensive. So I think this year to us seems like a great year for companies who were started a couple of years ago to raise follow-on rounds, but we have not been super active this year because of, I think we're looking for big ideas at the right valuations.
Yeah, I mean, agreed. I think, I mean, there's just been, I'd say, a significant increase in number of seed stage deals being funded, but the valuations at those levels are still relatively constant. I mean, they've bumped up, but they're not crazy. When you look at the Series A and Series B, I think, you know, going back, if you look from 2012 to today, the pre-money valuations have essentially doubled. And that's just not healthy for the overall ecosystem. And I think that's where you sort of sit back and when you look at, you know, average Series A valuations at, you know, kind of a, you know, 20 million and Series B valuations at a 40 million. And then you look at, you know, average exits going back for 30 years, you know, 90+% being at, you know, sort of 100 to 125 million. The math gets tough when you sort of add in the risk. Not to be the, you know, wet towel or blanket or whatever, but it's just, you know, there is sort of the reality factor that plays in. And, you know, so we think about that a lot. And, you know, I think in the markets that we're investing, you know, more heavily, you know, in some geographies tend to have a little, you know, a little more valuation discipline. It's just lower supply of capital.
Are there any sectors that are also sort of better deals right now? That's why I keep wondering if people are suddenly interested in synthetic biology. Like, it's relatively undiscovered by this.
You know, I mean, it's interesting. We've invested, you know, we've sort of continued to invest in e-commerce companies, I think, at a time where it's been relatively out of favor. And our feeling about it is that there's really never been a better time to start a new brand. And if you know, if you sort of look in the market and you look at what millennials are essentially driving, it's a completely different brand message, and an old brand can't change what they've done in the past, so you can't just change your messaging. They're marketing through completely different channels. You know, it's not television and newspaper, and you can't spend in big volume on a lot of these other channels, on Instagram yet, you know, really on Facebook, and those are kind of even old now. So, you know, I think that there's really never been a better time to start a new brand, and, you know, and so that's where we're really excited about, you know, still about e-commerce companies. If they have great unit economics and a great value proposition and a great brand, you know, we think there are great opportunities there.
There's never been a better time to be an entrepreneur.
That's for sure.
For sure.
Right? I mean,
yes.
Let's talk exits, and I want to give you a chance to talk. But you and I had talked earlier this year, and we were talking about the fact that there aren't IPOs, really. And you had said that you sort of thought that there was this private-public confluence, and that it's not going to change. There's sort of a permanent shift afoot. But at the same time, I think everybody on this panel wants their companies to go public eventually. I mean, have things changed in some permanent way, or are we like, deluding ourselves as these companies sort of linger in private?
That's a big question, but you're talking about players, about $50 billion that has entered the market to invest that wasn't here before. So far this year, $7 billion of capital invested from historically public investors, 11 billion invested last year, all of which is allowing companies to raise capital at a scale that's, again, unprecedented, which allows for a deferral, the ultimate public reckoning, if you will.
It is precedented, though. That's the thing. There was a time when this happened before.
That's right.
One precedent.
Well, except even then, if you look at 1999, the 29% of all IPOs doubled in value the first year, the first day of trading. 1% of IPOs have done that this year. So 29% versus 1%. This isn't a public bubble today. To the extent there's a bubble in valuation, it's largely private, which means if the gas gets let out of the bubble, it's going to happen in a slow motion way. It's not going to be some dramatic correction because it's not a public market that's been participating.
Right. But
does it ever happen? Do we see public investors participate? Of course, at some point liquidity is necessary. You'll likely see a correction, which is what we've seen. The last 6 IPOs have happened at corrective values relative to the prior private financings.
But in this case, is the correction the unicorns just sort of hitting a wall?
See, it's a funny thing. If you're a private company and you see this sort of correction happening, it's much worse for founders and employees for that correction to happen as a private company than as a public company, because you have preferences sitting on top of you from all of these investors who've put in all of this money, who are looking to get made whole before any proceeds go to employees and founders. If you're public, actually the math changes a little bit, right? All the preferences go away.
Right.
Everyone has the same class of stock. And so if there are fluctuations, everybody shares in them equally. Unlike, unlike in the private markets where, folks with preferences and folks who might feel like they overpaid in previous rounds are going to be very unwilling to have those preferences, messed with in the future if there's a requirement for more capital at a lower valuation. And so now you actually have better access to additional capital as a public company, and you have employees and founders in a more beneficial situation if there is some sort of correction. So it's kind of interesting that there's been this reticence to go public for companies who are able to do so.
That's great. I'm sorry, Jeremy. I'm having a little trouble hearing you. But okay, let's talk. This is a little bit.
We got to get him up on the panel.
I know. Where is that guy? Unicorpses. This is the word that everybody's talking about in the last couple of weeks. I was at a talk last week where Bill Gurley sort of talked about a few companies whose unit economics he didn't understand. He didn't necessarily say they were doomed. Maybe he implied it. I don't know. But I'm just curious if there are, there's 150 companies now that are valued at more than $1 billion. Are there any names, that you can maybe offer, again, a company that you don't know what its fate will be, but you don't necessarily understand its unit economics?
Well, I'm not going to name a name because that would be indiscreet. But the interesting exercise we have is we have to try to make investments where 100% of the investments work, given the scale of the checks we're writing. We're not playing alpha the way a $100 billion public fund plays, and ultimately it's a basket of investments. If you look back at 1992 and you made 100 investments and it was in the tech sector, you'd end up making about a 20% return on your capital by the time you exited 10 years later in 2002. But it would be highly concentrated in Microsoft and Intel. My suspicion is if you could invest across a basket of the unicorns, as Aileen penned it in 2013, you'd do just fine because you're going to have a few of these companies that do extraordinarily well, but there'll be a lot of roadkill. And there'll be a lot of companies that don't survive for exactly Bill's logic. Their unit economics don't work. And ultimately, in rising markets like we've had, people don't ask the hard questions about cash flow generation, unit economics, balance sheet, leverage of scale, et cetera. They focus on revenue growth. And we've all learned this lesson before. Ultimately, they have to get to a place where they generate cash. And ultimately, valuations are a function of cash flow.
Right. Well, let's hope they work it out. I have about 20 more questions for you guys, but we have to get going. Thank you so much.
Thank you.
I love talking with all of you.
Thank you, everybody.
Thanks.